Hello viewers, today we are going to discuss about one of the largest and the most important securities market in the world, the US Treasuries. The US Department of Treasury issues treasury bills, notes and bonds, which are also considered as safest fixed income investment in the world.
The difference between treasury bills, notes and bonds is length until the maturity. Treasury bills have maturity of less than 1 year. Treasury notes are issued for 1 to 10 years. Treasury bonds are issued for term more than 10 years. So the question is, how can you describe a bond?
When a government, a municipality or a company wants to borrow money from investors, it issues a bond with a coupon. A bond is just an IOU. A bond pays interest periodically and repays the principal at maturity. One can buy or sell these bonds in the secondary market also. So what is a yield?
In simple terms, yield means return. Don't confuse coupon with the treasury yield. The yield is the total return over the life of a bond, and that is based on the purchase price as well as the coupon. If the demand is low, the bonds are sold below the face value. As a result, yield is high. If demand is high, bonds are sold over the face value. As a result, yield is low. So bond prices and bond yields are inversely correlated. Milind, do elaborate the relationship between interest rate, bond yields and currency market.
Interest rates, bond yields and currencies are interconnected. When economy expands, interest rates goes up, which leads to higher yield and currency appreciates. Higher the interest rate, the more foreign flows comes into the country. That will strengthen the currency. If foreign investors buying US Treasury, they are selling their local currency and buying US dollars, which eventually strengthens the guinea. Bond yields actually serves as an excellent indicators of the strength of a nation's economy, which increases the demand of the nation's currency. Karthike, does equity markets gets also affected by changes in the bond yield?
Yes, it does. Equity normally moves negatively with bond yields. That means bond yields go down, the equities tend to outperform. And as bond yields go up, equities tend to underperform. This relationship may not exactly hold in a very short run, but if you consider it over a period of 5 to 10 years, this relationship will be clearly visible.
Karthike, here I would like to add further that investors also need to look into the reason behind the rising bond yields. If yields are rising gradually with the strengthening economy, the equities may not underperform. But if yields are rise abruptly, for example, due to some sort of financial crisis in the economy, in this scenario, equities will underperform.
In this case, does emerging market get affected by rising US bond yields, and what will be the implication of that?
Fundamentally, rising US bond yields means interest rates are going up. At the time when global debt levels are at its peak, that has to have an impact across the globe. Rising bond yields also tends to mean a stronger US dollar too. That is eventually bad news for emerging markets. It effectively squeezes the monetary policy globally, and countries like India and other emerging economies with high dollar debt but non-dollar income will continue to feel the heat, as it is the beginning of the end of the good times of easy money.
Thank you, Milind, and thank you all for watching the video.